Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people all throughout the world of crypto and blockchain. And this is season 9, and I have an amazing guest for you today. He is the co-founder of Vex Capital. His name is Ryan Singer. Ryan, welcome to the show.
Glad to be here.
Thank you. Thank you for joining me. And let's kick things off. I ask the same question to everybody. I get amazing answers. It's what is your background, and is it a logical background for what you're doing now?
So I co-founded one of the first Bitcoin exchanges. It was called Tradehill in 2012. We were the first exchange focused on institutions. So we had customers like BitInstant, Coinbase, the first mining pools, the first mining manufacturers, Pantera. When they started on our platform, the Winklevoss twins, all those people. And so the other institutional exchanges like Gemini and Coinbase Pro, they got started after we shut down in 2013. And we shut down because the government closed our bank for the crime of doing business with people, with institutions that just wanted to trade Bitcoin between each other.
Got it. So I was going to find that was pre Mt. Gox.
Yeah. Well, we were operating at the same time as Mt. Gox, and we continued operating after they shut down. But yeah, it was kind of the same era. And so since then, I've stayed focused on Bitcoin and blockchain technology, and what does that mean for institutions, and what does that mean for kind of global capitalism and not just retail investors. And as I've been going through that over the years, I've been doing a lot of work in Silicon Valley and seeing how the ups and downs of the venture ecosystem work. And I realized that just like crypto originally had more infrastructure for retail than for institutions, venture investing actually gets it backwards the other way. And they're so focused on treating institutions well that any individual shareholder of a venture funded equity is basically screwed. Because they don't have access to data, they don't have access to trading, they don't have access to pricing. So if you get venture equity in a acquisition or in an angel investment or from work, that asset's going to sit kind of dead on your balance sheet until the CEO decides they want something good to happen for you. And if you want to get into a venture funded stock because you're super excited about the product they're building and the effect that it's going to have on a market, the only way to get in is if you're best friends with a prominent venture capitalist or with the CEO. And so with Vex, we decided to take all of our learnings from over, it's been like 13 years now in cryptocurrency. So all of our learnings with over 15 years in cryptocurrency about new ways to build market structure, about new ways to build financial technology, and about ways to interact with the regulatory stack that's strategic and lightly regulated instead of heavyweight and over-regulated. We took all of those learnings and we founded a modern 21st century financial institution that's goal is to make every venture funded company trade every day, so that people who get venture funded equity through angel investments or work can get out, and people who want venture funded equity because they're excited about the change that those startups are making in those markets can get it.
Got it. Okay, that you piqued my interest. I want to find out, what Vex Capital does, how you do it, what you said, and then what the key learnings have been. And we've been through some different regimes. We had the 2017 very different than 2021, very different than today. So what have you learned to help you build that organization today?
Yeah. So when I started in Bitcoin in 2012, there wasn't even the FinCEN guidance yet. So at that point, all of the regulators were kind of scared and confused that there was this new open source money and venture funded companies started helping people trade it. And so at that point, all of the engagement with regulators was all about getting lawyers to write you legal opinions about how what you're doing could be regulated, and then trying to sell those legal opinions to regulators and convince them what their role was. And so that was very different than in 2017, when I was doing Chia and we were all doing the ICO bubble, and we were trying to figure out what are securities and what are not securities, and how do we make sure we keep the SEC kind of out of our hair while still protecting investors, because the SEC had no way to regulate a cryptocurrency-like instrument that could be self-custodied by users easily, that could be transferred easily, and that could be exchanged without a middleman or a broker, right? And so the entirety of ICOs was all about how do we avoid SEC regulation, because the technology wasn't possible at the time under SEC regulation. And now what we have, since the new administration and kind of the vibe shift, is all of the regulators are coming back to the industry like in 2012, saying, teach us. We don't want to stand in the way of the technology. We don't want to stand in the way of the consumer. We want to find reasonable regulatory touch points where we get to further our mission of fighting terrorist financing and protecting consumers without kind of sounding like dinosaurs and without regulating the wrong thing. And so it's now possible to build regulated infrastructure that deals with DeFi appropriately, that deals with wallets appropriately. We don't have to try to find ways to shoehorn out of the regulations like we used to.
That makes sense to me. I had an advisory company in 2017 during the ICO days, and I was trying to comply with the SEC, but every week the SEC changed their direction. So I changed my direction right out of having no direction and losing my business. Yes. So, that's the fear I had today, because I see a vibe shift. I see it, but I also see delays in ETFs.
Yes.
So what has actually changed when you look at the paper? Okay, this was accomplished. I don't see the accomplishment yet. What was accomplished?
So there are a few very notable changes. I think from the regulatory front, the most important one is the SEC put out clarifying guidance that transfer agents that are using blockchain to record transfers of securities are doing nothing wrong. And so that was always the industry's view, and the industry has been using transfer agents since 2017. But the new administration put out clarifying guidance, clarifying that that is absolutely correct, and those transfer agents are doing nothing wrong. And RIAs and other institutional investors like hedge funds that are relying on those transfer agents to follow the custody rule for private securities are also doing nothing wrong.
Okay, that's one.
And so that's a huge one, because that unlocked basically the entire world of Reg D and Reg issued securities on blockchain as being kind of explicitly okay.
Got it. So Reg A and Reg D, I don't usually hear those words nowadays, but they are important. So I want to ask about that.
And so we'll get to that. The other thing that they did at the new SEC that was also that they did in cooperation with the CFTC, that was also completely game changing, is they said there is nothing wrong with a commodities broker or a securities broker doing business with cryptocurrencies that are commodities and not securities. So there's nothing wrong with the securities broker or a commodities broker doing spot markets in Bitcoin or in stable coins or in Ethereum. And there's nothing wrong with a commodities broker that also does regulated commodities products like futures or derivatives or hedging, doing the spot markets either. So there was this understanding in prior administrations that while securities brokers could have unrelated businesses, cryptocurrency could not be one of them. And that understanding is now absolutely not the case. Cryptocurrency securities brokers have been giving firm guidance from the SEC that the SEC regulates the securities portion of their business. And if they're also doing spot markets in commodities, that's okay. And it's only the SEC's business if it leads them to doing something bad with the securities business, or if it leads a registered broker-dealer to lie about themselves or otherwise commit fraud.
Interesting. I like that one.
Yeah. So between those two, it's now completely okay for SEC regulated investment advisors, SEC regulated broker dealers, SEC regulated transfer agents to tokenize securities, exchange them for stablecoins, and exchange them for Ethereum and Bitcoin.
That's good. That's good. Yeah. That's good.
So, so it just cleared away so much fear and so much uncertainty. And all of that fear and uncertainty was doing nothing but driving American investors to foreign exchanges that weren't regulated by American regulators and didn't have protections like being able to complain to FINRA.
And it was driving American entrepreneurs to Dubai.
Oh, absolutely. I know a lot of American entrepreneurs that moved to Dubai and Singapore and just chose to double pay taxes and pay the US to get just because it got their companies mostly out of US jurisdiction. In fact, to this day, there are still ICOs where the terms on the ICO is they geo-block Americans and they say, listen, our perspective is what we're doing is not a security in most of the world. And even if it is a security in the US, it's offered under Reg S and Americans aren't invited.
Yeah. Towards the end of my ISO advisory days, I experienced that. We're not going to talk to Americans.
Yeah.
So, you know.
Even though the entire founding team is American and all the venture capitalists are American.
Yeah. So I want to get into, you know, the private, you said Reg A and Reg D. So I want to talk about Reg A and Reg D, the private shares market, and how do you create more transparency in the private shares area and the VC area as well?
Yeah. So what we're going to do, and we're already starting right now, it's in kind of private access, but soon we're going to open up for public signups for any QP in the world that wants to participate. And eventually these tokens will get to retail. But what we're doing right now is we're going to do an auction every day of a different venture funded startup. So the vehicle is we choose a startup that's raised at least $50 million. We create an SPV that exists for only the purpose of trying to buy 1% of that company on the secondary markets. And then we auction the right to invest in that SPV in order to value the targeted company. So say we target a company that their last venture round was $200 million, right? And we say, okay, we're going to go buy 1% of that company. If our users want to go buy that with us, what would you pay for 1% of that company? And the minimum bid is 0.1% of that 1% for $1,000. So the minimum bid is we're valuing the company at 100 million and we're buying 1 million of the company.
Okay.
And then we're just going to auction the units of that. And if the auction values the company at over 100 million, then we'll take that over $1 million that's in that pot. And our brokers will go and offer money to angel investors, venture investors, and former employees of the company to try to buy the company. And if we get the shares in the SPV, then we'll tokenize the units of the SPV according to SEC regulations. So if it was a non-US person that bought the units, they're tokenized immediately when we get the shares. If it's a US person, they're tokenized on the 1-year anniversary of the auction. And then once we tokenize those shares, they will trade every day on our platform and they will be compatible with DeFi.
Ooh. Okay.
So our goal is to make every startup we target, and we're starting with 1 per day. So that's 252 a year. Our goal is to make every startup we target trade every day without us having any opinions on price at all. The initial trading price that we try to acquire the shares at is priced by our customers in an auction. And then as soon as we get those shares in that fund, we just tokenize the units of the fund itself, and they'll trade every day.
So your customers, are they professional VC firms, or are they accredited investors, or are they like retail?
Our customers are anyone who confirms to us that they're a qualified purchaser, meaning they have $5 million or more. So that could be kind of crypto degens that have done really well in the market. That could be professional venture investors. That could be post-exit entrepreneurs or successful angel investors. But it's probably not what we traditionally call retail in securities markets. That said, once these tokens get out to DeFi, we won't be able to control who can access them on the secondary market, right? We can control who can redeem them with our advisor. You have to tell us your QP to redeem it with our advisor, and we can set limits where you can only redeem thousands or more at a time and stuff like that. But in terms of if you're a bona fide holder of these securities and they're not currently transfer restricted, we can't stop you from giving them to someone else. We just won't help you give them to someone who's not qualified.
Okay. You said they are going to be compatible with DeFi. How are they going to be compatible with DeFi?
They're going to be ERC20 tokens. So anybody who wants to will be able to make markets for them on Uniswap.
Got it. Interesting.
Although from a legal regulatory perspective, I advise against making markets in securities as a business unless you're a broker dealer.
That's a good advisory.
Yeah.
So,
remember to trade for your business. Don't trade as your business.
Okay. So the best ways to tokenize startups then and venture funded equity are, what do you feel are the best ways to accomplish that? Say I have a startup and I want to what are the best approaches?
So that's the big difference between us and our competition. So there are kind of three kinds of companies involved in kind of the tokenized secondary space, right? There are the ones that try very white glove to match supply and demand very carefully, and they're kind of old school OTC brokers. They're the ones that are focused on working with the CEOs, and then there's us. We just don't care about the company's management. We are going to value companies at auction before we speak to their management. We're going to acquire the shares where we're charging our brokerage fees to the sellers, regardless of whether or not they get ROFR'd. So if the companies try to stop the transfer into the fund through the ROFR mechanism, we'll still get paid and we'll still have the fund and try again. And when the stock trades up, we're happy. When the stock trades down, we're happy. And so the biggest difference between us and the others is everybody else is going to be trying to help the CEOs tokenize to accomplish the company's fundraising goals. We're going to help the shareholders tokenize to accomplish the shareholders' liquidity goals. And if that makes the CEOs happy, then we're happy. And if that makes the CEOs angry, then we're still happy.
I'm getting it. I'm not getting the part where you don't care about the management, because in today's world, most of the stock companies, people care about who the management is.
No, we care about who the management is in terms of disclosing accurately to the shareholders and helping them make informed investment and trading decisions. What we don't care about is whether or not the company wants to tokenize and wants to trade every day and wants to get a price every day. Part of the reason that that venture is broken is because every startup has three prices. They have the price that they tell the IRS, the 409A price, and they use that to price equity compensation. And they want that number to be as low as possible and secret. Then they have the price of their last round. And that's the price that the investors value them out, and that's the price that everybody kind of feels the company is worth. But that price is often 2 years old by the time they raise their next round. And the average company that's raised money has raised it over a year ago. And then the third price is the price they're raising at now. And they want that price to be as high as possible with the round still closing. And oftentimes they'll wait to raise a round until they can get an up round from the last price. What we're going to do is we're going to take every venture funded company where people have opinions and people want in and out, and we're going to collapse those three prices to one price. What was the last trade? Just like public markets. And so the game of venture valuation is going to go away. Every venture firm is going to have to trade every day and mark their prices every day, just like hedge funds.
This seems to me like be a huge deal.
We're very excited.
Yeah, massive. So let me ask you this, and I saw it on the news this week. Tether, right? $500 billion worth company, which should be in the trillions pretty soon. They're raising $50 billion. They don't need to do it. You know, some people think it's a flex raise. Like, why would they do that? Like, why if you don't need to?
Yeah, so there are a couple of reasons for a very profitable company like Tether to raise money. But they really boil down to two. One, they want to be able to take some money off the table, and they're using the money to fund a tender offer. Right. And this allows them to clean up old shareholders that maybe aren't aligned anymore, or it allows their founders to diversify their wealth into other assets, or things like that. Another reason to do it is to get strategic investors on the cap table at a negotiated price. These are people like your banking partners, or potentially people who have a lot of influence over politics or regulation or things like that. Or even just in Tether's case, distribution partners like crypto exchanges, letting them or their investors participate can kind of tighten the relationships and build more trust. And then the third reason to do it, and this is very important right now, this is of course why Gemini raised their round, is to prepare for an IPO. It's much easier to go public on public markets if some of your investors are already financial institutions that know how to describe and market and price your stock. And so with Tether, I'd imagine it's probably a combination of all three. I'd imagine that massive round is, one, to fund some tender offers to make sure that all of their shareholders are aligned and looking forward. Two, to make sure that their founders are appropriately diversified and not worried about their work and able to focus entirely on execution. And three, to get the right partners to be able to take what they're doing to the next stage, which I think very well will involve partnerships with major financial institutions growing beyond just their broker-dealer partnerships right now and their investment bank partnerships right now, and partnering with real commercial banks, and also looking at public markets as a source of equity and debt capital in the future.
So let's talk about those partnerships, and let's talk about your auction process. Your auction process helps facilitate partnerships, right?
So yeah, so once a company is on our platform, once we've auctioned to launch, we've sourced some secondary liquidity at the company, and we've tokenized and allowed trading. At that point, because there's a price every day, we're the best place, if you already have shares, to come warehouse your shares into our SPV, get your tokens, and start trading yourself. We're the best place to get more shares if you want to dip your toe in. Instead of trying to negotiate a venture round, just sign up for our platform, place a limit order, get some shares. And once we're there, we're actually also the best place for the CEO to raise money to, because there's no difference at that point between doing a venture raise and doing a Reg A, Reg D, Reg S offering on our platform at the market, right? We already have the price. We know what your company's worth. Come and see what kind of volume you can raise at that price to go build something better. And once we're there, the only real difference between trading on Vex and being public on NASDAQ is public on NASDAQ makes your shares Reg T and allows retail brokers to lend against them. That's the only big difference. And so what we'll do is we'll help people get into and out of these venture positions. We'll help every venture funded stock trade every day. And eventually we'll help those companies fundraise using traditional public market plays like at the market sales, like what are effectively pipes, where you do a big institutional round with a lockup, and then when it unlocks, it trades every day. And all of the and even debt offerings secured by this tradable equity. This is the whole playbook that public companies have had forever, at least since the 30s, that we're going to offer that whole playbook to every private company without having to register immediately, without having to do expensive and complicated financial reporting, without having to follow increasingly bizarre and baroque listing requirements, right? Like board composition requirements, ESG reporting. None of that is related to running a private venture funded business. And none of that's related to what the shareholders from private venture funded business are asking for. So we'll allow for kind of the maximum freedom for these private companies being able to access the public market playbooks while playing by private market rules. And then when they need the larger liquidity that's restricted to private markets, and when they are at the point of maturity, when complying with the traditional reporting requirements and complying with the exchange listing requirements isn't difficult anymore, then we'll facilitate them uplisting to NASDAQ, which we can do because of our partner, Vex Securities, which is a registered broker-dealer and a registered ATS.
Your time frame on all this is what?
We hope to start talking about our first auction successes in the coming weeks, and getting to the point where we're auctioning hundreds of companies a year in the next year. We expect the first tokenizations and trading will happen 3 to 6 months after the first successful auctions, because it's going to take time to source the private equity and get through the right of first refusal process and the transfer process and stuff like that. And then once we've got a lot of these companies trading, then we'll start looking at more interesting products like at the market offerings, like pseudo pipe deals, things like that. Another product we're very interested in looking at are what we're calling governance markets. So when you're investing in a startup, oftentimes you have a lot of opinions about what you want them to do, right? Do you want them to raise another round? Do you want them to keep growing first? Do you want them to keep the CEO? Do you want them to replace the CEO? Do you want them to seek merger opportunities, or do you want them to stay independent, right? What we can offer with our funds and with our tokenization platforms are conditional securities where you can invest money in the company if they have an up round by a certain date, or if they don't, or if they're acquired by a certain date, or if they're not, or even, and this one's really fun, if they keep their CEO through a certain date, or if they don't. We call those keep or can, and they're my favorite, because if can trades over keep, then it's a very interesting investment opportunity.
I want to dive into that.
In all of those cases, your underlying position is long the company's equity, but contingent on them making the decision you want them to make. And so all we do is we take a share of a company, we put it in the fund, and then we split that beneficial ownership into 2 pieces. One piece that converts into a unit of the fund if they have the up round by a certain date, one piece that converts into a unit of the fund if they don't, right? Or if they replace their CEO by a certain date, or if they don't, or if they're acquired by a certain date, or if they aren't. So this is a piece of legal technology that was invested to be able to do, that was created to be able to do merger finance and investment banking, but it's actually very broadly applicable to helping investors trade their governance risk with these startups, where the startup governance is everything. The board is incredibly powerful. The CEO is incredibly powerful. And this might be the only way that an independent investor that's not on the board can influence governance or hedge governance risk.
I I was picturing like some of the 1980s movies that I saw where people took over the board, but had like one person was able to make an impact on the board at a board meeting, and I'm like, it sounds intriguing to me, you know.
Yeah. Yeah,
Um,
that's right. Like, remember that Adam Sandler movie where he stands up at the shareholders meeting and he's only got one share left, but they still have to hear
yeah,
it.
yeah. So I want to dive into this concept of keep and can. Okay.
Yeah.
I want to find out like how. I mean, I don't know if you did, maybe you define it perfectly, but I'll find out what it means, and then how developing the keep or can approach will help investors diversify their portfolios.
Yeah. So what it helps them do, I think, is it helps them influence the management of their company they're investing in, even if they don't have a lot of a say, right? They're a minority shareholder. They might even be below the threshold to trigger a shareholder vote. And they have no access really to the board. But they have opinions and they know whether they're happy with the CEO's work, right? And right now, their only choices are find a buyer when they may be transfer restricted and may be very difficult to get the permission to sell their shares, or write off their investment, or decide to trust and wait, right? But with Keep or Can, they could literally split their holdings. Where they have their holdings right now, it's just 1% of the company, but they could split instead. Each one of those shares becomes a keep unit that's worth that amount of equity if the CEO still has their job on New Year's the next year, and a can unit that's worth that ownership in the company if there's a different CEO by New Year's. And then they can choose, do they keep the keep units or do they sell the keep units? Do they keep the can units or do they sell the can units? And an investor who wants to get in can choose, do they want to get in for the equity, or are they huge believers in the CEO and they only want to get in on keep, where if the company replaces the CEO soon, they don't want it? Or are they interested in driving a governance change and they're only interested in these kind of activist can units? And so when you start thinking of stock like that, where you can get the stock, or you can get the stock contingent on keep, or you can get the stock contingent on can, all of a sudden investment is also governance, right? Because if you're happy with the ship as it's going, then buying keep at a discount is just as good or almost as good as buying the equity. And if you're not happy with the ship as it's going, buying the can sends a very clear market signal to the board that there are investors who went in with a different CEO, and that their fiduciary obligation to the shareholders involves rethinking management.
I think as a secondary, impact of what you're doing, I think you're the first company that puts companies like Bain and McKinsey at risk, because their model is accountability as a service, and now you're telling the executives, hey, you have another accountability as to the token holders.
That's right. And the token holders will tell you when they're upset, because you'd imagine in almost all companies, keep is going to trade over can, because management turnover is bad for business. But you could also imagine in a company where a recent management decision was extremely controversial, or a manager is having personal problems, if can trades over keep, that is a very clear market signal that investors want change and there is capital available for new management.
I love it. So, so I have one more. I have two more questions. One, and I'm going to look forward to looking at that, the metrics on that. But one is, you mentioned early on, you mentioned transfer agency, right? So I know I've interviewed some of the people from Avalanche, and they were working on transfer agency years ago, still are, right? But in this new paradigm of institutional Bitcoin, institutional Ethereum, and maybe institutional Solana and Avalanche treasury companies, what will be the role of transfer agency going forward? What do you think?
Yeah, so transfer agents are kind of a really interesting regulatory tool that nobody ever talks about, right? Because all of the kind of retail investor facing financial institutions are all either broker dealers or they're investment advisors or they're both, right? When you think of Fidelity, they're a broker dealer and an investment advisor. When you think of E-Trade, they're a broker dealer and an investment advisor. Schwab, broker dealer, investment advisor, right? Everybody that's operating funds and marketing to the public is usually one or the other and often both. Transfer agents have existed for just as long as broker dealers have and longer than investment advisors have. They were created by the same 1934 Act that created the broker dealer framework. And they existed before that. And the 1934 Act didn't change what they did so much as it codified it. But what a transfer agent does is it's hired by an issuer of securities, which means either a fund manager or the CEO of a company. And it's hired by that issuer to help them figure out how to handle their shareholders, how to account for them correctly, how to process changes in their shareholders, and how to handle corporate actions like votes, dividends, or share buybacks. Right? And that's what a transfer agent does. So historically, the transfer agents have been very busy doing that work until 1983. In 1983, the stock markets for all the public companies consolidated all of the custody of all of the securities and all the public firms into the DTCC system. And because of that centralized custody and centralized clearing, the transfer agents for all of those public companies sorted into a much more specialized role, where now all of a sudden what they're helping the companies with isn't tracking every single shareholder, making sure every single shareholder gets the accurate dividends, making sure there's votes and the buybacks and stuff like that happen appropriately. All of that effort actually moved into the DTC and broker dealer system. The transfer agents now, what they do is they help the companies deal with the DTC and broker dealer system, and they help the companies track insider trading and the insider trading share plans and things like that, and the equity compensation, because that's the one thing the broker dealer system isn't equipped to do, are the transfer restrictions, right? So when you look at companies like ComputerShare, which are the big public transfer agents that all the public companies use, their focus is actually mostly on securities compliance for companies that are not financial institutions, working on the insider trading stuff and the equity compensation stuff and all of those things. They're no longer dealing with the investors directly. They're just a compliance layer in between the public companies and the financial institutions, and they're a very thin compliance layer, right? Most of the compliance happens at the financial institution level. But private companies increasingly are coming back to transfer agents after decades of not using them. For decades, private companies have kept their cap tables in spreadsheets that are emailed back and forth between the CEOs and the law firms. And that's it, right? And whenever someone asks for a cap table, what happens is the CEO would email a spreadsheet to the law firm, and they'd say, "Can I send this?" And then the law firm would manually check the spreadsheet against all of the employee agreements and the investor agreements to make sure it was up to date. And then they would email back, either make these changes or, okay, now it's fine. And then the CEO would email the cap table, usually to a prospective investor, right? Those were the only people who ever got to see them, were prospective investors in due diligence, right? And that would be what CEOs would do from literally incorporation until IPO. And then at IPO, they would hire a transfer agent to take control of the spreadsheet away from the CEO and the board of directors and the law firms, and to run it as a financial institution ready for compliance with Wall Street and ready for compliance with federal securities laws. But now what you're seeing is companies are increasingly turning to partners like Carta, where Carta is a transfer agent, but what they do is they administer private shareholders. so that an angel investor or a venture investor or even an employee can log into their Carta account and they can see their share certificates and their foreign NA pricing for every startup they're invested in. And you're getting some startup employees where they skip jobs every 2 years, where you're, as an employee alone, not even as an investor, you've got 10 companies in your Carta over a 10-year, 20-year career. And that re-engagement of private companies with transfer agents, which has been driven by the accounting needs of the venture capitalists and been driven by technology, just making it easier to offer these platforms and making it cheaper to do this kind of administration. Like at this point, a private company transfer agent in Silicon Valley costs maybe $1,000 or $2,000 a year. And in some cases, JP Morgan provides that functionality to startups for free. So now that you're seeing people doing that more and more, it's building more comfort with private companies using a transfer agent and letting go of their cap table management and doing it in a regulated way. Because remember, every transfer agent is regulated by a federal regulator, either this SEC or the FDIC or the NCUA, right? So by letting a regulated financial institution manage the cap table, these startups are professionalizing and they're reducing risk, but they're also opening up opportunity to start tracking transfer in a much more liquid way. And that's going to become even more true as these transfer agents adopt blockchain technologies and tokenization.
Well, I want to thank you for that answer, because I used to think, that the executive comp was only handled by a specialized group of small tax attorneys who were already, represented the big institutions, and no one had any chance to, do anything about that. But I'm glad there is. So I want to thank you very much for your time today. Very enjoyable and educational conversation for me. So I have one last question.
Okay.
It's how can people find out more information about you, about Vex Capital? How can they do that?
So they can sign up on our partner's website, vex.trade. Vex.trade is operated by our broker-dealer partner, Vex Securities, and it is right now the exclusive way to access products built by Vex Capital. And we're excited about having people sign up there. It's right now limited to people that are telling us that they're qualified participants, that they're truly wealthy and they're able to participate. But we hope over time to see our products migrate on chain and to see the whole world participate in DeFi.
Awesome. Thank you very much for your time today.
Take care.